If you own a business that's being sued, you might be wondering whether you need to mention the lawsuit anywhere in your financial statements. I mean, you could lose the lawsuit and have to pay up, but on the other hand, you might win and not have to pay a cent, right? Or the lawsuit might be withdrawn and not even go to court. In that case, why would you mention it in your accounts? Well, what we're talking about here is something called a contingent liability. You see, a liability is something you owe, like a loan you have to pay back, while a contingent liability is something you may or may not owe depending on the outcome of a future event, which in this case is the outcome of a lawsuit. And as for the question of whether you should mention the lawsuit in your financial statements, well, you may need to, because readers of your financial statements, such as investors or lenders, would like to know about all your liabilities before they give you any money. So let's take a look at what exactly contingent liabilities are and when you should mention them in your financial statements. In a nutshell, a contingent liability is a potential financial obligation that may occur depending on the outcome of a future event. We've already seen that lawsuits are contingent liabilities, and other examples are warranties you provide to your customers and government investigations. While each of these things may end up going against you and costing you money, they're only recorded in your financial statements if there's a decent likelihood they're going to occur, and if the value of the liability can be reasonably estimated. In fact, contingent liabilities are divided into 3 categories, and only 2 of those categories require you to mention the potential liabilities in your accounts. Category 1. Probable. If the loss is probably going to happen and the amount can be reasonably estimated, you are required to include the contingent liability in your accounts and on your balance sheet. For your lawsuit, this means that if it's probable the other party will win the case and you'll have to pay them $100,000, you'll need to include $100,000 as a contingent liability on your balance sheet underneath your current and non-current liabilities. Category 2. Possible. If the loss is possible and you can reasonably estimate the amount, you only need to disclose it in the notes accompanying the financial statements. This means it won't appear in your accounts or on your balance sheet, but instead it will be a note in your financial statements that investors, banks, and other interested parties can read. Category 3. Remote. If the loss has only a remote chance of happening, you don't need to disclose anything about it in your financial statements. So, if the lawsuit against you only has a small chance of success, you don't need to make an entry in your accounts, include it in your balance sheet, or mention it in the notes section of your financial statements. So there you have it. Now you know what contingent liabilities are and when to include them in your accounts and financial statements. To find out about the other 2 types of liabilities, current and non-current, check out the links to our videos in the description below. Also, check out our channel and the links below for more videos on assets and liabilities and how to use financial ratios to compare them and assess the health of your business.